All right, let's dive right into a really interesting technical analysis that paints a pretty wild picture for India's Nifty index. It lays out a potential roadmap, and believe me, the destination it suggests is a big one.
So here's the big question on the table. Could the Nifty actually surge past 32,900 by the year 2026? Now I know, that sounds like a huge number, almost audacious. But the whole idea is built on a very specific pattern of market corrections and rallies that seems to have repeated itself over the last few years. So let's play detective and look at the clues.
To figure out where we might be going, we first have to look back at where we've been. And our investigation really kicks off with what this analysis calls Phase 1, that absolutely insane post-COVID roller coaster that basically reset the entire market.
The drama of this period was just off the charts. Back in early 2020, when the pandemic first hit, the market went into a freefall, a staggering correction of almost 40%. But what happened next? Well, that was even more incredible. We saw this powerful V-shaped rally that didn't just erase the losses, it blew right past them.
Just look at that number. A gain of over 11,000 points from the low in March 2020 all the way to the peak in October 2021. This wasn't just a simple recovery. It was an explosive, upward move that really set the stage for a whole new bull market. And that's the key takeaway here. This massive rally set a new benchmark for what was even possible.
So, you might be thinking, okay, but that was a once-in-a-lifetime pandemic thing, right? A total one-off event. Well, the next phase of the market suggests that might not be the case. This is where a clear pattern really starts to emerge.
Between late 2021 and the middle of 2022, the market cooled off again. This time, we saw a correction of about 18%. Now, it wasn't as bad as the COVID crash, for sure, but it was still a pretty significant dip. And then, what do you know? Just like before, that correction was followed by another powerful, sustained bull run.
And this is where it gets really interesting. The point gain in this second rally was almost identical to the first one. Again, just over 11,000 points. The similarity there is pretty uncanny, and it suggests this isn't just random market noise. It could be a repeating cyclical behavior. Okay, so that brings us to the most recent period, which the analysis calls Phase 3. This is the final piece of our historical puzzle, and it's what sets the stage for the forecast we're about to look at.
And yep, here we go again. From its peak, the market saw another correction, this time around 17%. Very, very similar in size to the last one. But just look at the response that followed. The rebound from those lows was incredibly fast, which shows that the underlying upward momentum is still very much alive and kicking.
In just 8 trading sessions, the index clawed back 2,400 points. Think about that for a second. That kind of speed and strength is exactly what analysts see as confirmation that the pattern is holding up, and it could be paving the way for the next major leg out.
Okay, so let's just pause and recap for a second. We've seen 3 distinct phases. Each one has a correction followed by a really powerful rally. And the 2 big rallies that are complete were almost identical in scale. So what happens if this pattern holds for a third time? What does this historical blueprint tell us about the future?
And now we get to the really exciting part, the forecast itself. Using these historical cycles as a foundation, the analysis starts to project potential targets for 2026. This is where we stop looking back and start looking forward.
So to make these projections, analysts use a tool called Fibonacci extensions. Now, don't worry about the name or the complex math. The easiest way to think about it is like stretching a rubber band. Based on how far you pull that rubber band back, that's the correction. This tool helps predict how far it might fly forward when you let it go. That's the rally. So, if we apply that rubber band idea to our pattern, the analysis lays out this potential roadmap. Think of it like a series of checkpoints. The first hurdle is getting past the previous high, around 26,273. If the market can push through that, the next major target zone is sitting near 29,000. But the big one, the major final target based on this whole pattern, is way up there in the 33,600 zone.
And really, this quote here sums up the key takeaway. The fact that the price is currently consolidating, kind of moving sideways after that last quick rebound, suggests it's building up energy. This analysis concludes there's a higher probability of an upward breakout sometime in 2026, aiming for those levels we just talked about. Which brings us right back to where we started. We've looked at the repeating pattern of correction and rally. We've seen the technical projection that points towards a potential major move. So the question remains for the market to answer.
Will the Nifty surprise us all and actually make a run for 32,900 by 2026? Well, based on this analysis, the roadmap is certainly there.